38 years ago, the market melted down in a single day, and technology was to blame. Today, the same ingredients are back. High valuations, a hype tech, and false sense of safety. This isn't 1987, but the lesson still applies. When everyone thinks nothing can go wrong, that's usually when it does. Yesterday in New York felt like any other Sunday in October, but it was strangely warm, perfect for a drive into the suburbs, for pumpkin picking, and a cup of hot apple cider. Fall is in the air, but the heat felt oddly out of place. I took a trail hike with our pup Eloise, and as usual, she led me farther than I planned. Halfway up the hill, breathing hard, I flashed back to another warm day in October, 38 years ago. It was a Monday, and it started like any other Monday. Stocks were on fire, valuations were stretched, the price-to-earnings ratio of the S&P 500 was in the low 20s, almost exactly where it is today. Sue Herrera was on Financial News Network, Ron Insana was on the floor of the New York Stock Exchange, and CNBC, it didn't even exist yet. The Fed had just cut rates, then reversed course when inflation started to creep up. Unemployment was high, but it was falling. GDP was growing at 3%. The economy was humming. Tech was the rage. A global PC revolution was underway. The spreadsheet was the new frontier. People feared that it would wipe out jobs. Lotus 1-2-3 was king, and Microsoft had just launched Excel 2.0, a quiet little piece of software that would ultimately change the whole world. That fear of technology, though, that it would erase jobs, turned out to be actually laughable. The spreadsheet didn't destroy accounting, it supercharged it. What used to take a team of analysts a whole week can now be done in an afternoon. The PC actually became the great multiplier. The lesson? Productivity isn't the enemy, it's the engine. And every tech revolution since has proven that point again and again. But in 1987, the future felt a little uncertain. Tech stocks were the glamour names: IBM, Apple, Compaq, Hewlett-Packard, Lotus, Intel, and Sun Microsystems. IBM was the blue chip poster child. Apple was the upstart, charismatic but chaotic, 2 years removed from Steve Jobs' exit. Compaq was the fastest growing company to join the Fortune 500. Microsoft was a year into its life as a public company, promising, but hardly the giant that it is today. Investors could not get enough. Hardware, software, and semiconductors were the AI and crypto and cloud of their day. New, powerful, and poorly understood. And they were priced for perfection. The setup was textbook. Valuation stretched, sentiment euphoric, confidence through the roof. Between January and August, the Dow surged 44%. Every dip was bought. Every pullback was a buying opportunity. And like so many times in market history, when everyone agrees nothing can go wrong, well, it probably already has. The first cracks appeared in the bond market. 10-year Treasury yields climbed from 7 to nearly 10%. The dollar weakened and trade deficit fears grew. And suddenly, equities looked rich compared to 10% risk-free returns of bonds. It's just silly math. Then technology turned on itself. Wall Street's program trading, a new tool, began executing large automated trades. The idea was portfolio insurance. Sell futures when stock falls, limit the damage. But the system had a flaw. The more stocks fell, the more it sold. And on October 19th, those programs unleashed a self-feeding spiral. By 9:31 a.m., selling pressure was already building. By 10 o'clock, the decline was sharpening. Traders watched as bids vanished. By 11 o'clock, the Dow was down 150 points. By noon, the market was in utter chaos. The tape was hours behind. Nobody even knew where stocks were trading. Futures and cash markets fell completely out of sync. Index arbitrage broke down completely. By 2 p.m., the Dow was down 300 points. Paper flew across the New York Stock Exchange floor like a snowstorm. Clerks, they were running in circles. And traders, they screamed into their phones. And by the close, the Dow had fallen 508 points. A 22.6% collapse in one day. The biggest one-day loss in American history. The next morning, the world woke up in shock. Fear of a systemic collapse were real. And then new Fed Chairman Alan Greenspan spoke. He said 30 words. The Federal Reserve affirms its readiness to serve as a source of liquidity to support the economic and financial system. That's 30 words, you can count them. Those words created the first Fed put, the one that we so much love today. Confidence returned, markets stabilized, and within 2 years, stocks had recovered their losses. The aftermath rewired the market. Circuit breakers were born, program trading was regulated, and risk models improved. What was once a dangerous tool evolved into today's algorithmic backbone. Technology didn't destroy finance, it professionalized it. And just like the spreadsheet didn't kill accounting, it made it better. That productivity boom helped drive the 1990s expansion. Fast forward to today, the echoes are impossible to miss. Rich valuations, dominant tech giants, euphoric sentiment. Our modern market darlings are Apple, Microsoft, Nvidia, Amazon, and Alphabet. You know the ones. The digital descendants of IBM, Intel, and Compaq. They're redefining industries, commanding premium valuations, and testing investor faith once again. The difference is scale and speed. Algorithmic trading now accounts for most daily volume. Information flows at light speed. Market corrections that once took days now happen in minutes or seconds. But our infrastructure is stronger. Circuit breakers actually work. Capital buffers exist, and the Fed knows how to calm panic like that. Yes, forward PEs are back in the low 20s. Yes, tech is dominant again, but this isn't 1987. Inflation is sticky, but it's not raging. The Fed is alert, not asleep. The economy is cooling. It's not collapsing. What 1987 teaches us isn't fear, it's humility. Markets don't die, they reinvent themselves. As Eloise tugged her leash on the way down the trail, the air still warm, I thought about how markets always find balance. Black Monday didn't end capitalism, it rebooted it. And that's what markets do best, over and over again. So your truth bomb for today is this: history does not repeat, it just speeds up. And if you're not paying attention, tech won't be your edge, it'll be your trap. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.